Ever since the housing bubble burst back in 2009, US banks have been speeding to issue car loans instead. But now many people are having trouble keeping up with monthly payments, and that is stoking fears among lenders. Americans owe more than $1 trillion in car loans, which is 70% higher than the tally back in 2010. But now the banks are hitting the brakes. In the first quarter of this year, the number of new car loans fell for the first time in 6 years. And big banks that have doled out more than a third of these loans are scaling down and scaling back their forecasts for the future. TRT World's editor-at-large, Craig Copetas, joins me now. Craig, subprime anything terrifies me nowadays. Back in the 2007, 8, 9, when we started to hear about this, it was like, so what? Who cares about the US subprime market? Doesn't bother me. Oh, dear.
Well, bubble, bubble, toil and trouble, Matthew. The three pillars of the American dream are housing, education, and cars. The housing bubble has burst. The student loan problem is about at $1 trillion in debt. And as you mentioned, we're looking at $1 trillion in car loans. This is rocky ground, and maybe the bankers are a little bit too late off the mark on this, because what this growth comes from is people buy because of the GDP, your gross domestic product, and as the American Nobel Prize winning economist Joseph Stiglitz a number of years pointed out, he said GDP is not a good measure of economic growth. It's not a good measure of well-being. What it is, however, it's an indicator of disposable income that now has kind of become an indicator of indisposable debt, and there's just too much of it. Quick figure, Matthew, and take a deep breath here. There is currently $8 trillion of debt globally carrying negative yields. That's real serious folded money.
Well, Craig, let me ask you about the comparisons with the subprime mortgage market. Back in those days, it was the real estate agents and the dodgy mortgage providers who were initially at that first stage to blame. Do we have now car dealers behaving in the same reckless way, trying to help people with very low credit ratings to buy vehicles they can't afford?
Well, it's not the car dealers, it's more of the automakers who go into business with these banks to help finance cheap cars now, or cheap car prices. Now, a third of, as you said, of these risky car loans are bundled into bonds, okay? And these bonds are called deep subprime. That's the term. And it is essentially a highly technical financial term for fecal matter. They lead to late payments and delinquencies. And if you look at how the banks and the automakers have structured this, if you go back to 2010, 5% of car loans in the US fell into this deep subprime category. Now, nearly 33% of car loans in the US are in deep subprime territory, and that's not a good thing.
Craig, what happens if enough of these loans go bad, if enough people, if it becomes a critical amount of people are not paying back these loans? What could happen to the financial system?
Well, again, it would cause an implosion. It would cause a major rupture. The extent of that rupture is actually quite hard to track right now, because we don't know in detail actually who's holding these loans. We know for a fact that Wells Fargo, for instance, is very much involved in this. But what it would probably be, Matthew, is it would fall upon the banks, as it did during the subprime crisis, because the banks are the ones for packaging and selling these loans and creating the debt.
Sounds horribly familiar. Craig Copetas in Paris, thank you so much.